All right, let's talk about a huge idea that could completely shake up your wallet and honestly, the entire financial industry. It's a proposed 10% cap on all credit card interest rates. Now, on the surface, that sounds like a total win for consumers, right? But the reality? Well, it's a financial hornet's nest. So let's get into it.
So where does this idea even come from? Well, it comes from a really simple and powerful argument. The credit card companies are just charging way too much. The idea is to put a hard stop to it, to protect people from what a lot of folks see as just predatory interest rates.
And that really is the multi-trillion-dollar question, isn't it? I mean, a lower interest rate feels like such an obvious win. But the second you start to peel back the layers and see how the credit card industry actually works, a much more complicated picture starts to emerge.
Okay, so let's dive right in. To really get a handle on what a 10% cap would do, we first have to understand the real numbers behind that piece of plastic in your pocket. This is the number that gets all the attention, an average APR of almost 24%. It's a pretty shocking figure, and it's exactly what fuels the argument that something needs to change, and fast. But that number, as high as it seems, is really only the beginning of the story.
But here's where it gets really interesting. While that advertised rate is 24%, a major credit card issuer like American Express is actually earning something closer to 11.8% on their portfolio. So you got to ask, where did the other half go?
And this right here is the core of the problem for the banks. This proposed cap of 10% is actually less than what a big, efficient bank is currently earning on its credit card business. I mean, that means the entire business model just stops working. It suddenly becomes unprofitable. So the key thing to get here is that the 24% APR isn't just pure profit for the bank. It's really a big pool of money that has to pay for everything. It covers the risk that some customers won't be able to pay them back, it covers the cost of fraud, and it even pays for all those fancy rewards, the cash back, the travel points, the airport lounge access that a lot of us really like. It's a super competitive system with a ton of costs baked right in.
And this is where the law of unintended consequences really rears its ugly head. As investor Bill Ackman points out, there's a huge flaw in this plan. If banks can't price for risk anymore, meaning they can't charge higher rates for borrowers who are less likely to pay them back, well, they're just not going to offer them credit at all. And that kicks off this really dangerous ripple effect. Because if banks can't price for that risk, millions of people, especially those living paycheck to paycheck, who really rely on credit as a safety net for things like an unexpected car repair or medical bill, they could suddenly have that lifeline just cut off. And where do they go then? They might be forced into the shadows of the financial world, having to deal with payday lenders or loan sharks whose rates and terms are so much worse. Some analysts are even worried that this kind of credit crunch could be big enough to actually trigger a recession.
Okay, so now let's look at how this all plays out for a real company. Let's talk about a major fintech player, SoFi, which finds itself smack in the middle of this whole debate. For them, it's this crazy paradox. It's both a mortal threat and, maybe, a once-in-a-generation opportunity.
SoFi's main product, their bread and butter, is a personal loan that's designed to do one thing really well: help people escape that crushing high-interest credit card debt. In fact, more than 80% of their personal loan business comes from customers who are just consolidating their credit cards.
The threat to their business is crystal clear. Right now, SoFi can take your 24% credit card and swap it for a 16% personal loan, and you save a ton of money. It's a great deal. But if that credit card rate is suddenly capped at 10%, well, SoFi's 16% loan isn't the hero anymore. Their entire value proposition just evaporates overnight.
And you might be thinking, well, why don't they just lower their rates to 5 or 6% to compete? The thing is, they can't. Just look at their own costs. The bare minimum cost of offering a loan, what they have to pay for the money themselves, plus what they expect to lose from defaults, that adds up to over 6%. And that's before they've paid a single employee, run a single ad, or built any new tech.
But here's the wild twist. In what you can call a move of high-stakes corporate judo, SoFi CEO has a totally different take. He believes this massive disruption isn't the end of their business, but the start of a huge new chapter. How on earth is that possible?
Well, his logic goes something like this. The 10% cap makes traditional credit cards unprofitable, so all the big banks pull back from the market. This creates a giant credit void for millions of Americans who still need to finance things. SoFi, with its super efficient personal loan platform, can then swoop in and fill that void. Their marketing would totally change, from fix your old debt to finance your new purchase smartly from the start. In this new world, they'd become a primary lender, not just a company that helps you refinance.
It's a fascinating strategic chess game to think about. But after exploring this whole high-stakes scenario, we have to pull back and ask the most important question of all. Is any of this actually going to happen?
Because for all the talk about the economic chaos, the whole idea might be dead on arrival. And it's for one simple reason. It's probably not even legal.
So here's the deal. According to legal experts, credit card rates are governed by something called the National Bank Act. This law goes all the way back to the Civil War, and it lets national banks export the interest rate rules from their home state. Think places like Delaware or South Dakota, no matter where their customers actually live. A president can't just wipe away that long-standing precedent with an executive order. Congress would have to actually change the law itself, and you can bet any attempt to do that will get tied up in court for years.
So what's a more likely path forward? Well, instead of a hard price control, we're more likely to see a government push for market-based solutions. We're talking about things like promoting financial education, making it easier for people to find those refinancing options like SoFi's personal loans, and encouraging tools that help people consolidate their balances. This kind of approach could still really benefit companies like SoFi, but without blowing up the entire credit system in the process.
And that leaves us with the final and most crucial question. The idea of a 10% cap was born from a very real problem, over $1 trillion in high-interest consumer debt. So if a simple price cap isn't the answer, what is? And how do we help consumers without accidentally taking away the very credit they depend on? The search for that answer? Well, that's one of the biggest challenges facing the financial world today.